Hello and welcome to the Monday Futures Market Outlook for April 2nd, 2012. This is Patrick Srezna. For those of you that have not had the opportunity to try out enesource.com's trading room, complimentary memberships are available on the website. As always, when we try to look at the forecasting of the stock market, we always have to start and look at how the intermarket relationships of the whole market are developing. And the first thing we want to obviously look at is the U.S. dollar. And we've continued to see the last 2 weeks, almost 3 weeks of U.S. dollar continue to consolidate off of short-term highs. We continue to suggest that that 78.50 will behave as a very important support, and it's not even necessary for the U.S. dollar to make it down that low. Inevitably, we think that if you just draw even a trend line along all those highs at some juncture, when the U.S. dollar strengthens above there, it would indicate it coming to the top end of the range. When we go to our 2012 bigger picture forecast, we still believe there is plenty of room for the U.S. dollar to have another substantial rally at some point. It doesn't necessarily have to begin off this low, but we do believe that these support lines represent a level where some of the lows of this year will come in. Next year, when we take a look at the euro, we like to always look at the euro to kind of understand what's in store for that U.S. dollar. And the euro also has been finding a lot of heavy overhead resistance around the 134 level. Really at this stage, it could be developing a head and shoulders top. So we don't want to conclude anything like that yet. It's far too early with no technical evidence. But we could obviously even see a very short spurt that could see even a double top retest along the 135 level. But in the bigger picture, we also believe that the upside potential of the euro is pretty much going to have some substantial overhead resistance, and and every time the euro tries to rally, it will find some selling up at these higher levels. In the bigger picture, again, we think that the euro needs to still have one more leg of a devaluation this year. And it doesn't necessarily have to begin off of this high, but we do believe that there's only a limited upside in that euro. Next year, we're going to take a look at the 30-year Treasury bond, and when we obviously hit that short-term low right along that 135, 136 handle at this stage, we've seen the Treasury bond strengthen. We've wanted to identify this kind of zone right up below the 140. In the end, 140 acted like a support for the entire consolidation from November till March. And really, now that we've broken below it, we have to look at the fact that a lot of our retracement zones lie right at that 140 level. So that should be a substantial hurdle for the 30-year Treasury bond to beat. And if it did, it would be a very bullish indication. Really, at this stage, there was nothing stopping the 30-year Treasury bond from let's say even going for a double bottom retest or even making a little bit of a lower low on the downside before really putting in a bigger bottom. The question really becomes, if the euro reversed here and the US dollar started to rally and we started seeing commodities and everything start reacting, would the 30-year Treasury bond sell another cycle, or could we actually see strength in this 30-year Treasury bond? We are going to be watching that, but we again think that 140, 141 above is a very, very important level to watch on these. Next year, I want to take a look at copper futures, and we've identified a couple tops that we've seen developing along the $3.90 to $4 level. We, in the bigger picture, believe that this is a substantial place of overhead resistance for copper, and there's no denying that at this point with the fact that we've consolidated here for 2 straight months. Really at this stage, there would have to be a very big intermarket shift to really get a good sell cycle in copper going. But if we saw that euro breakdown and a US dollar rally, may be sufficient to create some distribution in copper prices. Next year, I want to take a look at crude oil. And crude oil, we drew this flag on there, and we were suggesting that any break above the 108 level could open the window for a rally even up to 112 to 118. But we really never did get any follow through up in that zone, and it brought in some very aggressive selling. We're now on the opposite side of the spectrum, where we're at actually a very important support line around this 101 to 103. At this stage, if we still saw the bulls recover this off of that zone, then there's still room for crude oil to have another leg higher. It would be any serious price action deterioration down to, let's say, the 96 to 98 zone down below that would really start putting the nails in the coffin of a crude oil trade. Now, obviously, there's a geopolitical influence on this. As if there was a confrontation on Iran, there would be another input variable to put in here. But there is no denying right now that there is technical distribution going on in crude, and it's at an important support line that if the oil bulls let this zone give out on the downside, it would really show a lack of strength for those that are accumulating crude oil to really get some follow through on that. Finally, I want to take a look at gold prices. And gold is at an interesting point. We've been identifying this declining wedge and identifying that so long as that retracement zone in the 1640, 1630 zone did not give out, we couldn't rule out the possibility that that gold would work its way back to 1750 on the upside, particularly 1720, where all the lows came in February, would be a very interesting place for gold to retest on the upside. At this stage, the only way that I'm going to become bearish on gold would be any substantial break below 1630. At this stage, there's room for gold to work its way up. I'm not bullish in a sense that I think that we're going to beat 1800 on the upside, but so long as the 1630 zone holds, we have to be open to the idea that gold can tack on an extra $30 or even $50 on the upside over the upcoming weeks. That brings us to wanting to look at the broader markets, and we always start that off with a weekly chart of the S&P 500 going back 3 decades. When you plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles we've gone through. Last year, we went through a number of false starts along that moving average line, but now we're distinctly trending higher and above that 80-week moving average. So at this stage, we have to be distinctly biased to the fact that we are in a bullish advance. We will take some sort of a substantial break below the 1300 level on the S&P to really give some sort of a bear market signal. When we're talking about that weekly chart, obviously we're identifying a bigger picture weekly bullish trend, but on the daily charts we are actually looking for a market correction. We've now gone an extended period of time off the market bottom in a bullish advance that literally sees from the October low till now a clean 30% rally in the S&P, and we really at this stage in this advance will see the market get heavy and begin some sort of a 5 to 10% market correction, which is very natural. The market never really ever has a market advance that isn't followed by a correction. So a correction is a certainty here. It's just about what level it comes off of. Really at this stage, there are some technical measurements that suggest the market could make it even potentially as high as 1450, but there is substantial overhead resistance in that 1420 to 1440 area. If the S&P fails to even make it back to the 1420 high and rolls over, then really what you want to do is literally watch the trend line, which can be just connecting all of these different bottoms, and just simply recognize that anything that rolls over here that did not make a higher high and that breaks this trend line would be the first clues that a bigger picture daily chart correction may be underway. We believe a market correction could easily see 100 S&P points off the top, so we could see 1320, 1300 on the downside during one of these types of market corrections. It doesn't mean that we're going to be beginning a new bear market. It's just a much needed correction in that would probably end up being a buying opportunity. Finally, I wanted to just take a quick look at our key intermarket observations. We remain neutral on all of our short-term forecasts. We don't necessarily believe that the US dollar or commodities have signaled any big moves. And even though bonds have broken down, they have not really broken down key levels to indicate a new downtrend has begun. Stocks are in an uptrend with only limited upside potential. So really, we don't feel that there is a need on the short term to be negative nor optimistic on it. We think that the market will continue this kind of choppiness for even a few more months. In the bigger picture, we remain bullish or optimistic that the US dollar relative to the euro and yen and other currencies will actually have a bullish advance. Commodities should weaken in that cycle, and during that time, money will flow into bonds. We put that a neutral position on the long term for stocks because we don't necessarily believe that this has to lead to a new bear market in stocks. But it would lead to a much needed correction. But we feel that it would be too much of a negative bias for us to be outright bearish the markets unless it is a bear market. And so we're going to remain even longer term neutral, which it still will leave lots of room for 100+ point S&P swings higher and lower, just not necessarily a bear market. That was your Monday Futures Market Outlook. Thank you for joining me.